Welcome to Silicon Valley Impact, where business insight meets startup innovation. And now, your host, Brian Sparks!
All right, thank you, Brian. Well done. The bar was set and you reached it.
Did I hit it? Am I okay?
Yeah, you're good.
My energy was a little off today.
No. You landed it. Way to stick the landing. Welcome to Silicon Valley Impact. I'm your host, Brian Sparks. The purpose of this show is to have honest conversations about what it takes to build great businesses and communities so that you can make an impact within your own. And Brian, I'm pumped today. We have two amazing guests in the house. We have Lindsey Mignano, back from SSM. There's too many S's in that one. SSM.
Just two S's.
Just two S's. But she's back here to give us some great insights, and she brought the legendary Peter Walker. So welcome.
I got to say, if Peter's any more legendary than Lindsey, then we're in for, fasten your seatbelts.
I'm 100% a tier below Lindsey. I want to make that clear.
I get all my
everyone.
lawyering from Peter, so really, clients, you're overpaying me.
I have not gone to law school, so that's a problem.
Everybody is so different. I really appreciate that.
Well, for me, the imposter syndrome is in full effect. So everyone knows what I'm talking about. Peter, go ahead and give yourself a quick little intro to our audience, if they don't know you already.
Absolutely. So my name is Peter Walker. I am the head of Insights at Carta. If you're not familiar with Carta, we are an equity management platform for about close to 50,000 startups here in the US, as well as running a fund administration business. So we help both founders and VCs figure out their lives. And my role is a pretty unique one. I get to just kind of surf across all of the data we have from those companies and help founders and investors make better decisions with that data. So I've been at Carta for about 3 years now.
So if you are a startup, lean in, record this, because not only with Peter, we have Lindsey back. And Lindsey, for those tuning in for the first time, give a little intro about yourself.
Sure. Thank you so much. My name is Lindsey Mignano. I am a co-founder of SSM. We broke off from bigger law firms to form a women-owned corporate law firm in 2016. We've been virtual ever since. We have attorneys in Seattle, Los Angeles, and San Diego and San Francisco, with San Francisco being the predominant hub. And so I'm one of the founders. Very happy to be here today and always happy to sit across from Peter. I have all of my clients and even the people who work for me look at your LinkedIn and follow you aggressively to make sure that we're on top of the ball and seeing anecdotally what you're talking about statistically. So thanks so much for making the time.
The North Star is in the house. Yeah.
I think Lindsey is responsible for like 80% of the enthusiasm around my post. So I really appreciate her.
I love it. And you two have been friends for a while.
Yeah.
I think it just seems that way.
Yeah, you came in here and it was
we barely know each other.
Yeah, I couldn't tell you.
Yeah, it was like a family reunion when you two walked in the door.
I gotta be honest, we did at one point, I caught Lindsey out in San Francisco having a meeting with the whole firm
at a bar.
And having a couple drinks at a bar, and we stayed a little later than we expected. So that was a fun night.
We closed it out.
So we hope that translates here today. We're gonna have a little fun. This is gonna be a light lift just to kind of get to know a little bit about what's going on in the ecosystem right now. It's ever changing, a lot of things at play. But from a high level, Peter, let's talk with you. And of course, we're just going to have an open conversation about the startup ecosystem. What is the significance of Insight? Because I told you I love that title. What is it that you really lock in at Carta as head of Insight?
Yeah, I think basically it comes down to the fact that a lot of early founders are building effectively in the dark. You know, you can get some information from your VCs. You can certainly get some information from your lawyers. Maybe you have founder friends who have done this pathway before. But it seems like at every checkpoint, you're kind of making decisions with very little data to back it up. And one of the advantages of my role and Carta in general is that because we have so many companies on the platform, we can aggregate and anonymize that data to help give you some sense of what reality actually looks like. So what is the market today for AI startups or biotech or, green energy, et cetera? We can give you real numbers on those things. Now, you can't just take that number into a meeting with a VC and said, hey, Carta said so we're going to do this. But at least you're working off of like a similar shared reality instead of hearing from one founder friend that your valuation should be $100 million and the other founder friend says 20 million and you're like, I don't understand which one to take.
Yeah. So when a founder comes to you or someone who's thinking about starting a company, what stage are they generally in that you could be most helpful?
So it used to be that companies would join Carta, seed, Series A when they were maturing businesses. These days, actually, most of our founders join us at the idea stage. So a couple people in a garage when you're first ideating around those ideas. The reason being is because they can get started on Carta for free. So when you do that, I think that our tech and software becomes a lot more helpful in addition to the data, because then you can kind of grow up with the platform. And again, it's completely for free until you raise $1 million. So I think our data is probably the most helpful to the earliest possible founders.
And how important is it for early stage founders to have this kind of data as opposed to just focusing on building their product or service, building their team? How can they really integrate these insights to get traction quicker?
I think you just nailed it, is that you want to spend as little time as possible on the mechanics of company building. So your insight as a founder is, I understand this customer really well and we're building a fantastic product for them. You don't really want to be sitting there and talking about, okay, what's the expected dilution in this fundraising round? Or like, should I use safes or convertible notes? Those aren't things that are going to make or break your business. You want to take those things and, use what data says as a guide to them, and then focus on where you have competitive advantage, which is your product, your customers, et cetera. So I think it actually really helps. For instance, you mentioned building your team. One of the things that I think we've put out recently that's very, very helpful is, okay, what do you give these early employees in equity? I'm hiring a first engineer. How much of the company should that person have? Should it be 1%? Should it be 5%? Like, these are big decisions, but again, you're kind of making them in a fog of lack of information. And then if you look at Carta, you see a couple social posts perhaps, and you can at least go into that conversation saying, here's the range, let's have a discussion.
So let me kind of pause it before we go down that rabbit hole of more data. When can they use it? Where did you get your teeth in the game? Like, what is it about your past that had you fall in love with this ecosystem and doing what you are doing now? So let's kind of back it up a few years and give me your run up on what really drives you to be so engaged in this community.
So I've been in startups basically my whole career. I actually started a company in college. It didn't really go anywhere, but it got me the entrepreneurial bug. And then I was employee number 11 or 12 at a startup in the East Coast called Public Relay. And we did media analytics. So like an early version of natural language processing for media. Amazing place. I got to dabble in a bunch of different things. And when COVID hit, I actually sort of took on this other role at the COVID Tracking Project, which was a sort of a nonprofit started by the Atlantic magazine. And our job was to make sense of what was going on in COVID data across the US. If you can remember, at the very earliest part of that time, you could go on Twitter and have vastly different ideas about what was happening in the world just based on who you were reading. And so our goal was to say, let's take data from as many state and municipal websites as possible and visualize it in a way that presents reality. And so that has a very natural through line to me looking at other data sets and saying, oh my gosh, I love startups. Startups need this sort of information and visualization process. Where should I go? What place has the most data on startups? And like Carta is obviously number one on that list.
Yeah. And so when did you land in Silicon Valley?
6 years ago.
6 years ago.
Following a girl who ended up becoming my wife.
Oh, nice. Congratulations.
Exactly.
Great story. The love story part of it, the softer side.
100%. Yes.
Just out of curiosity, followed from where?
DC.
Okay.
We were dating in DC, and then she got a job out here at Google, and it was made very clear to me that I should also move. And so we did. It took me a little.
She had to explain it to you, and
Look, man, I'm not saying I'm the sharpest guy here. Okay, there's like I'm not gonna send her down over the water without me here. But it did take me 6 months to figure that out.
Nice, I love it.
So you're a quick study.
100%.
So Lindsey, get in on this. Before we went live and started recording, there was so much to talk about. What is new within just the ecosystem? What is the landscape looking like right now? And then we'll start to weave in data perspectives, which Peter talks a lot about. What is the state of startup right now?
So we are seeing seed and Series A, Series B raises at this point. I would say they're not as voluminous in terms of deal count as they were in 2021, but they're starting to trickle back in, and they're bigger than you would necessarily expect at an earlier stage. So we just finished a Series seed of about 4.7, which is a little bit bigger than the 3-ish. We have some that are going to Series B, some that are going to Series A. The ones who are going to Series A or doing a Series A extension are the ones who are going to Series B. I think these are companies that have been in the market looking around for capital for the past couple of years, let's say since 2021 or 2022, if not more, and they survived. They cut staff. They stopped paying heavy lawyer bills. They made it work. And they're going back to market right now because they're either going to raise or they're not going to succeed. And so we're seeing really interesting ways about going to do that in terms of what they're surprised about, which is usually valuation issues, what they can command, even when negotiating a bridge. And we're seeing bridges come in anywhere from, say, $3-6 million at A or B, or for extensions, right? And we can call that an extension or a bridge. I think it's either. We're all in the same ecosystem here, so I think people call it different things. But I think we're seeing a lot of that right now, and we're hearing a lot about that right now. And I think it's interesting because it's either that, or we're seeing companies either just straight out go out of business, reorg, or spin out because maybe the lead VC from the first Series seed will not participate in the Series A, is kind of writing this company off, and we need to make some more room for possibly a pivot and possibly a new lead, new money to come in. And so it's somewhat happy times for some people. It's somewhat sad times for a lot of others. But I think this is like a world of have and have nots right now. I think there's some people who are very qualified, who've always had good metrics, who hired appropriately, who didn't overhire, or when they laid off appropriately, and they're going to make it. And I think there's a lot others that are just not where they need to be, both from an ARR perspective or get to the next spot without X dollars perspective, that we're going to see do some fire sales, asset sales most likely.
Now between
the
both of you, because you're seeding it with a lot of great insight. I keep dropping that word, insight.
It's all right. It's great. It gets
inspired me today.
I love it. Yeah.
You're seeding your conversations with a lot of distinctions that I really want to lock in on. The haves and have-nots, those who are making it, those who aren't making it. What are some of the characteristics of those who are bobbing and weaving, in challenging times and be able to lean in and move forward versus those who are just getting knocked out? Are there any distinctions that you can identify in these times?
I think it would be all the usual metrics, but on roids. So strong product market fit, enough of a space, really good partnerships. We see VCs asking not only for annual recurring revenue, let's say it's the numbers you would normally say 2 to 4 for Series A, 500 to 1.5 for Series Seed, especially a bigger Series Seed.
Yep.
We're not only seeing requests for those at the ARR stage, but we're actually drafting at SSM our contracts differently for our clients, such that the money comes in the door on that subscription on day one.
Wow.
Because that's an aggressive ask.
That definitely
It's
is.
an aggressive ask. But
What do your founders, are they taken aback by that?
I think they're negotiating it, right? So the issue is like usually have, for an early stage founder, an enterprise software licensing agreement that's like a freemium model for B2B for, let's say, 90 days. And then it normally shifts into a paid model. And VCs sometimes in harder economies like this one are not just asking for money on paper, but they don't want money on the streets. So they want that money collected up front, which makes sense in a harder economy, because if you're a little seed company who's partnering with big tech or big co, that money is a drop in the bucket for those companies. They can afford to pay all at once. Yep. And that's kind of becoming the more preferred model for enterprise SaaS, other than just kind of a monthly subscription with chasing money.
So, Lindsey, real quick, we had Luke Holman in here a few weeks ago. He was talking about pricing and packaging. And you're talking about, money on the street. Some of these terms here are not familiar, including myself. Can you tell me a little bit more about the importance of these founders pricing and getting out their packaging appropriately? Is this sort of what you're talking about?
Yeah, I think what we're talking about is what kind of VCs are expecting or wanting to see, which is more than what they used to want to see at a very early stage. They're asking for more, they're asking to do more with less, but they're also kind of hoping that not only do you have annual recurring revenue with some key business partners, but that they're paying you in full up front for that year on day one, right? As opposed to on a monthly basis, because chasing to collect is always a different story than actually having it in the bank, right?
I think some early startups are also moving, as Lindsey was mentioning, from a monthly subscription service to annual or even multi-year contracts, which, good and bad, it's a plus because you actually have cash in the bank that you can then take back to those VCs and prove your worth. Bad in that, one, it might sour relationships, but two, there's also a less flexibility in year 2 or 3 of that contract. So I think it makes total sense. On the other part that Lindsey was mentioning earlier on haves and have-nots, I don't think it's ever been more true, even here in Silicon Valley, of like just the kind of founder you are dictating your ability to command certain valuations. So this is what feels oftentimes very unfair to a lot of people who are just getting started in startups. And I'm here to tell you that it is unfair. 100%.
Absolutely.
So it's like it's the founder fit, the quality, the leadership.
Repeat founders are doing just fine in this economy. We had one that had not even fully incorporated his company before. I think General Catalyst gave him 2 out of a 3 million seed. And so there are repeat founders walking around in this economy, and they are commanding capital and they're getting capital because VCs already know that they can exit a company successfully, and so they're going to put their money in hard times, I think, in more conservative bets like repeat founders.
It's such a strange sort of mental model when you think about startups, because they're already so risky to begin with, right? Like the vast majority of these businesses are going to go to zero eventually. Will then the VCs make slightly less risky choices at the very beginning just to try to conserve their capital? So the difference between investing in a successful repeat founder versus investing in a first-time founder, even if that first-time founder is in the same industry and maybe has more traction. Maybe they actually have a product that has real customers, but you see the repeat founder who just has an idea on the back of a napkin get a higher valuation and more capital than that other person who already has a real business. And a lot of that is just pattern matching, obviously, from the VCs saying, look, we're going to take bets in this risky environment. We're going to try to turn the risk just a little bit down, and we're going to take a bet on that repeat founder.
And I think that makes sense. Look at how the economy is performing right now in the stock market. If you're an LP, then you're really going to lean on your VCs to return good ratios. You want that as an individual investor. You want a 3 to 5 times, right? But you're gonna want that level of success, especially when you could put your money in the market, not have it be locked up for 10 years and do relatively well. I mean, I'm up this year more than I think some of the VCs are promising at the early stage.
It's a great point. We could talk for a long time about that dynamics within the VC general partner community up to the limited partners and how this downturn in venture, specifically the lack of exits, so no IPOs.
Exactly.
Very few mergers and acquisitions happening. So there's a lot of capital that on paper may look good or bad depending on the valuations, but isn't being returned to those limited partners. And so what do limited partners do in some cases? If they're Stanford, the endowments, right, they're going to continue investing. If they're high net worth individuals who maybe just started becoming limited partners in venture to emerging managers most of the time, maybe they're just not going to re-up for fund 2. Right? They're like, look, I haven't seen any returns from this. I was expecting returns in 5 to 7 years and I haven't gotten any. Maybe I'll just do something else with my money.
Put my money in the market or put it in real estate syndication or put it in blue chip art, which is doing incredible. I think it's really hard for early stage VCs, so the VCs that are cutting pre-seed or seed checks, to command money from wealthy individuals, even accredited, when the other metrics without less time in the market and with the liquidity factor are doing really well right now.
Yeah. This whole like downturn has had ripple effects up and down startups. You know, from the founders to the VCs to the limited partners, they're all kind of cascading in that way.
What do you got, Brian? I see your hand.
Can we go to our break a little bit early here, just for a quick second?
Yeah, sure. We can go to a break. Yeah, we'll do that.
We'll
come right back.
Yeah. All right, we're back. We had to take a quick little break because I had to acknowledge the rumbling that's going on, and it's not Lindsey's stomach. There is some construction going on just across the parking lot, so I want to make sure we called out the elephant in the room and it wasn't distracting. But it sounds okay. We're good. We're good to go.
I think everybody might be hearing it just a little bit in the background. We're actually feeling it, like I can feel the building kind of rumble. But I just want to say, you guys right here, right now, are amazing, and you sound awesome.
All right,
so I don't think it's going to be a distraction for anybody.
So we were talking about really what are those things up front that are characteristic of founders that helps them move forward or get knocked out, and then we started talking about what it is that investors will look for to continue to invest. And so some of the things that were popping up early were, we were talking about the founder, we were talking about the go-to-market strategy, we were talking about partnerships, and we were talking about pricing. And then we were kind of parlaying that into, well, that should have traction, and that will then be grounds for reinvesting. If we're to pick up that conversation about what's important, and I think we were tapping into a little bit more about what's not fair for certain founders, whether it be their personal character qualities, their connections. Lindsey, you called them Nepo babies at one time, I remember.
Oh, yeah. The repeat founder Nepo babies. That,
I mean, it's a strong pipeline.
Strong pipeline.
I love it. If you have it, you have it. If not, but
children of majors VC firms.
Yeah.
Exactly.
I love that term. Okay, so what else is top of mind in terms of what is sustainable within the team, within the founder, and the matrix that determines, okay, this is going to be a winner?
There's so many individual things that kind of make or break the potential investment. I think a couple points to make here. One, there's no magic number. So a lot of times founders will try to ask, what sort of revenue are you looking for in order to lead my Series A? Mm-hmm. And they'll get responses from VCs that are anywhere from 1 million to 7 million to 10 million to whatever it is. And the idea that they should take away from those conversations is not that there is actually a magic number over which this deal will get done and under which it's not possible. Mm-hmm. It's all about how you can position your story as a founder to make the case that the VC would be absolutely silly to pass up on you, right? Because they're seeing a whole host of other companies. This is actually probably one of the underrated things about this moment, is there are a ton of companies that raised in 2021, early 2022, that maybe raised their seed rounds then, that haven't yet made it to Series A. Mm-hmm. But they're still in the VC's inbox, right? Like you can think about the mental model of these VCs. They're meeting thousands of these companies. And so you're not just competing with some amorphous threshold over which it works, you're competing with actual individual other founders. And those founders have gotten a lot more, tenacious over the past 2 years. I mean, their revenue is moving faster. Their teams are smaller. They're more capital efficient. Some of them may even be approaching, although not very many, profitability at that stage. And it's a more difficult game to get funding.
And I think what we have at least seen is with VCs being more specific, like we used to have a lot of founders who had a platform as a service, and we're just going to use enterprise SaaS because it's so popular in the Bay Area, but a platform or a software as a service with a almost hourly consulting model kind of built in all at the same time. In the past couple of years, the ones who have been active on the venture market, at least soliciting VC feedback or talking to us, have learned that sometimes VCs are saying, okay, I need you to really spin out this platform so I can see what the real financial metrics are, what's scalable, repeatable sales, and not you and your buddy doing hourly tech support for this platform, right? How can we separate out the income? So we're seeing them get smarter over time in scrappier environments. They're spinning out and finding a way to capture that data for the VC when some other very, very early stage startups maybe house it all in one. So that's a competitive factor. And then for the foreign founders, we do a lot of foreign founder flips. So that's a company who has raised anywhere from 2 to 5 million abroad, and they're really coming here for their seed 2 or their Series A, and that's usually a priced round, and that's the only reason we're acquiring a flip, right? But they have recurring revenue in Europe or in Canada or in New Zealand or wherever they're coming from. So they have a little bit of a competitive advantage because they have some sort of process in place, which may or may not work in the US, but they already know how to go to market in some ways. They already know who their target is in the US. Otherwise, they wouldn't have be coming to flip here or even open a subsidiary if they're not at the flipping point. But it's something that they can show data and success in other countries. Whereas some of the really early stage companies that are just making that inbox, they haven't had a scalable model, and so they don't have anything to reproduce. They're still trying to figure out how to get there. Yeah. And I think that is a really interesting inflection point in terms of what you're seeing from the slightly more mature early stage startups. Are
you seeing that VCs are more or less interested in taking on those foreign founders?
I think it just depends, right? I think I've seen some invest in some super popular areas, AI being one of them, abroad, and never require a flip, just happy to invest directly in UK limited company or whatever it would be called. We had a Series C in the gas and oil tech space that raised in Europe and is coming here for just pure expansion, possible flip to D. And so I think it just depends. Yeah. I think AI companies are really getting all the dollars these days. And so
I think we should get credit for not mentioning the word AI until about 25 minutes into this conversation.
Yeah. That's fair. What are your stats? 1/3 or more than that?
Yeah, it's something like 25 to 30% of capital, which is, when people hear that, they say, oh my gosh, it's AI is taking over the world. Well, true and false, right? Like you can raise as a non-AI company. It's not a requirement. Will you get put to the top of the VC deck stack if you have AI on there? Depends. They're hearing a lot of pitches with the word AI. So AI maybe a year ago would have gotten you in the door in a way that candidly now it probably won't unless it's AI infrastructure or dev tools or something. There's been a distinction within AI and it's becoming a little bit more
I agree.
of a targeted hype cycle as opposed to any AI company, we just want to see them all.
I agree. I think last year we had all these companies on our existing docket who were like, well, we're kind of AI. Right. And all of a sudden,
in right here,
all
right?
of a sudden that showed up on deck, right? And I think that was because the market was responding to that. And then now I think VCs are a little more sophisticated. They want to see what's in your stack, what's actually proprietary, what is something that it can actually be ethically scaled in light of changing rules and regulations. And so I think there is more selectivity there now. And I think, I don't know, I don't have like a percentage of what that is, but I feel like at least last year, it felt like everyone was like throwing spaghetti at a wall and just seeing what would stick. And now we're seeing kind of everyone's still AI. Like most of the companies that come to us now are AI, whether they're coming downstream from bigger law firms or they're coming just to incorporate, right? I still see a lot of AI enterprise software, B2B or B2B2C, but I do think it's more refined. And I'm actually really interested in the solutions that target the energy efficiency of AI and compatibility systems, because I think that people are saying that's going to be the next wave of AI.
So Lindsey, real quick, we went by it really fast. Both your minds are incredible just listening to you two. It's just like, hold on and pay attention. But you were mentioning a little bit, and Peter, you were talking about this too, about companies that are coming in from overseas. We get a lot of companies that come in. What are some characteristics that are helping some of these companies that are scaling? Because we led with the scaling piece. Like, it's just not an hourly thing me and my buddy are doing. There's a strategy to scale. And then we kind of parlayed that into, these international companies. What are the character qualities that international companies need to be aware of in order to be successful landing in Silicon Valley?
Right. I think this is a really good one. And we have a lot of Europeans, a lot of like German founders, UK founders on our docket right now. I think there is some cultural dissonance with regard to how America markets and sells versus how Europe markets and sells. And I think in times where you are expected to be leaner, so you're seeing a lot of founder-led sales, they're competing against American entrepreneurs who are very aggressive on sales tactics, right? And I think that is something that is a cultural shock for them about how to go to market in the US, how to do business, how aggressive you have to be on the follow-ups. I don't think culturally they find that super tasteful the way that we do it in America. I
think that some American founders have trouble with it too, because you're playing in this big pool and there's a ton of little minnows and they might be in some sort of adjacent industry to you, and some founders are just relentlessly aggressive on that, and some founders find it kind of hard to stomach.
And I think some founders who do that though are the squeaky wheel that gets the oil, right? Yes. And makes it to the top of that person's inbox and is remembered. And I do think that there are a lot of foreign accelerators in the Bay Area, and this is something that they routinely refer out to like sales consultants to help people from other places learn how to go to how to do partnerships in the U.S.
So is that same as you said earlier, is partnerships being key? So for international companies to come over and to develop the quick partnerships to deal with culture, would that be something
I would say that the VCs in America are happy to see your numbers abroad in terms of your ARR, but they are funding an American company. If you're flipping for venture financing, in theory, you've already opened up a US subsidiary and there is enough traction in your product or service to warrant an American investor to flip your company and then help you raise money here in the US, right?
So the flip, to be clear, is just the Delaware flip, in that it's pretty much the case that it's incredibly difficult to fundraise from American VCs if you are not a Delaware C Corp, because there's a ton of tax advantages that lends to that, both the startup and the investor. So foreign companies that are coming over here, if they want to take priced equity, are going to need to consider becoming Delaware C Corps in a flip called the Delaware flip. That doesn't have to happen immediately, but if you're going to raise venture capital from US investors, someone's going to mention it to you pretty quick.
And I would say we get a lot of people who call prematurely, and we have to explain to them, like, this is going to shock everybody, but like a $80,000 to $150,000 transaction. So you better have a really healthy Series seed or a Series A for this. Otherwise, the workaround would just be to, take the money into the subsidiary via a safe note with a side letter that allows for a 1-for-1 exchange upon a reorg, right? Like that's a cheaper way to do it. And some VCs will take it. Some VCs won't.
Sure.
But I do think if they are thinking of raising in the US, VCs when it comes to a significant Series A level are going to want to see recurring revenue, not just in Europe, but in the US. And finding those partnerships, finding a way to culturally help those founders understand how they have to go to market, especially if they don't have connections from Stanford and Cal with all these big tech, big co for these partnerships, which a lot of, this is the reason why the Bay Area does so well, because we promote so many of these inter-university connections, right? If they don't have those connections, how do they go to market? How do they get that repeatable scalable sales model, especially with immigrant founder-led sales coming to the U.S. with no connections, right? And I think that is just one more thing that's harder for them beyond the cultural fit.
It's really tough. The other major difference that we find, so we actually, as Lindsey mentioned, there are a lot of different accelerators now that are foreign-led, but in the Bay. So they'll take cohorts of German or South Korean or New Zealand companies and bring them over and say, it kind of expose them to the startup market in the US. We sometimes lead some sessions with those folks. And one of the biggest changes or interesting points that they have is just around the way that equity works in the US. So first and foremost, does everybody get equity here? It's not always the case that if you're a German company that every single person in your company is going to own a little piece of that startup. Actually, it's pretty rare for that to happen. In the States, it's almost impossible to find any high-growing VC startup that doesn't have ownership for basically all employees at the very beginning.
Agree.
So
interesting.
That is a very different kind of cultural shock that sometimes people come across, and they'll look at the equity percentages that we give out for early employees and they'll go, that's great, that's so high. And then, the same day we'll get feedback from employees here in the States, it's so low. So maybe that says we're doing something right, but it is a cultural shock for them.
Yeah. And so again, let's keep clicking on that go-to-market strategy. What are some other things that you're seeing that are necessary to scale and pivot? Not only if you're coming in from another country, but also here. I think that turn at velocity can shake out a lot of companies.
I've been hearing this, and I don't know if you've heard it. I've been on a couple of VC panels where I've heard VCs mention a product market fit. Everyone understands what that is. Founder market fit.
Yeah.
Why this founder? Why this time? Why this industry? If they have previous experience, for example, let's say it's an insurance tech startup. Do they have, experience in the insurance, sector such that they can, get those partnerships in place? Do we like that? Or do we want a complete outlier who has no experience because we want to have them reinvent it and take a fresh set of eyes to it? And I think that can cut either way. I think it's a really interesting thing. And I've heard VCs on various panels that I've been on waffle between the two. And I don't think there's really any consensus, but founder market fit, whether it's an experienced founder who comes from, 15 years of insurance and is building out an insurtech product, or a complete newbie who has a way of reinventing it because he or she isn't bound by 15 years of knowledge of insurance regulations, right? I have heard that about from VCs on various panels at the early stage, which I think is again, we're asking for more. At an earlier stage with less to give out. So it's a great time for founders.
It's just always wonderful for founders. I think they're buffeted by two sets of advice. So on scaling, first and foremost, there's the question that was a little bit out of fashion in 2021 and 2022, but is much back in fashion now, which is, should you take VC at all?
Oh, yes.
Should you be a venture capital backed business? Taking VC money implies a certain set of growth characteristics about your business for which the venture investor will push you hard. So if you take VC money, you are committing to a growth path that is very aggressive. The general concept would be 3-3-2-2-2. Triple your revenue in the first 2 years, both years, and then double your revenue each of the successive 3 years after that. That's hard to do. I mean, you're talking about real money, real growth at that point. So a lot of founders are looking and saying, I think that this is a fantastic business and I'm going to bootstrap it.
Or they're just going to take angel money or seed VC money. So I just got back from Seattle Tech Week. We were having a conversation about this. compared to like the 16 or 17 billion that we deploy in the Bay Area, Seattle only deploys like $500 million a quarter, right?
Yeah.
And they have a lot of really, really, at least from the week that I was there shaking hands, kissing babies and meeting with VCs, they have a lot
They
of
let
like,
you kiss babies.
oh, I know,
That's
right?
wonderful.
Even post-COVID, you wouldn't believe it. Now I'm probably sick, so watch out.
Yeah, we can inch further away.
You know, it's quite a smaller market, and there are a lot of really early stage pre-seed VCs who are cutting checks to Seattle startups, you know, 150, 150, 80, and not at the Bay Area numbers, right? And they're only cutting checks to that community. But when you actually talk with that community, what I think is so interesting is because we're in the Bay Area, we're also inundated with venture. That's the way to grow. And I think there is an alternate ways, especially when in areas where you're not seeing as much venture deployed, and they're scrappier, and they might take venture, but in like a safe note or convertible note if they're in some parts of the country, usually safe on the coasts, as you know.
Sure.
But that really never necessarily converts at an equity financing round. It may be just as some instart of capital, and really the goal is to build it up and then sell it, right? And then that's when the VC makes its money. But it's not with a goal of raising it to Series Seed, Series A, Series B, like doing that traditional Silicon Valley jig, right? And I think that's really interesting to watch, especially in harder times when things are leaner and venture capital is not deploying as much as and it's not as frothy of an environment. Then there is a natural kind of reset of like entrepreneurial mindset, which is like, do I really want to do this song and dance?
Well, right. So I got a question right there because I've been waiting on that one. So Peter, you brought this up. Should they take VC money or not? What should a founder be asking themselves?
That's my stomach, guys.
Yeah.
You really got to stop kissing those babies. There's something seriously wrong there.
See?
Yeah.
That's
what should a founder be asking of themselves to make sure they're just not in survival mode? Like I've got to have the money. I got to keep raising. Versus
just unimaginable. I'm so sorry. I mean, Brian, you're looking at me like I've done this to you, but I had nothing to do with it. This is not something I chose.
The walls are closing in, honestly. It's like,
it's like we're stuck in the garbage.
Do
I'm Han Solo, and I got to put the brace up to keep the walls from closing in on me.
Do you think the VCs are listening into this conveation and wondering if we're going to just turn founders off to the venture capital path?
They're probably asking themselves why we don't have some sort of AI audio buffer to get that. Yeah, exactly.
So let's power through that. What should a founder be asking themselves in order to take that money?
I think it's a matter of like whether you really are a venture fundable business. And I get this a lot because we're lawyers, and in theory we don't give business advice. In theory,
yes.
In theory, a company comes to us and they say, "Hey, I have this technology. It's a platform. I want it to be venture funded," right? And we have to say, okay, well, we'll set you up for that as if you are going to be a venture-funded vehicle, Delaware C Corp, all the bells and whistles. We'll set you up with 401 vesting and double trigger acceleration in your stock agreements. We'll make you look and smell like a venture company. But I think in the Bay Area, there's so much pressure to go that route that no one's even really thinking like, this is the most expensive capital that I'm going to ever purchase, right? Do I really want to grow at that cost? What about my personal life? What about, I see the founders who actually do grow at that cost, and their personal lives do take a backseat for a little bit,
100%.
Right? And why this, why now, and why my business, right? And I think, as lawyers, we see a lot and we hear a lot of ideas. Everyone's like, this, you never heard this. Like, actually, we've had 5 calls this week about something very similar, but we can't tell you what it is. And whether or not that's really going to be something that's venture fundable, I think is a question that they have to ask. Whether or not the market is there to provide those returns to venture LPs, right? Are you really in that market that it makes sense for you to be venture fundable, or are you really more of a company that can take a little bit of venture in like a safe note capacity and then just become a really profitable small business? And we've had a few fintech on our docket who just raised on convertible or safe notes and became, fine.
Wonderful
never had to go to Series A, never had to cut that other additional 20% dilution. And I think, they don't, not everyone does that math at the beginning of incorporation or even shortly after incorporation, but they all want to preserve the opportunity for that. I think that's different in other parts of the country.
I don't think it's possible. So the question of whether or not companies should take venture capital, first and foremost, the answer is almost always no. which is kind of surprising. The vast majority of small businesses, even tech-enabled small businesses that start in the US, should not take venture capital. As Lindsey said, it is the most expensive capital in terms of ownership you will ever come across. So your default should probably be no. Get to the second question, which is how big is this company going to be? And I realized that it sounds like a very silly question to ask at pre-seed. You just had this idea. How could you possibly know how big this is going to be? In order to be a venture success, a successful venture company, you need this to be worth $1 billion minimum. Probably actually more like $2 billion now. Is this company ever have a chance to be worth $2 billion? That's the question you're asking yourself when you're taking on VC cash. Now, interestingly, there are ways these days that are popping up more often where perhaps you set yourself up for the venture path. You take in a little bit of funding and then you make the more difficult decision and say, look, I don't think that's going to be us, but this can still be a great business. And we treat our safe investors correctly, or we have some sort of conversion mechanism where we have an exit for people on a, call it 5 to 6 year timeline that makes sense. That is not traditional venture. Traditional venture is, I'm going to invest in this business and you are going to be NVIDIA. And that is like, especially in an exit environment where there are very, very few IPOs, fewer and fewer companies probably actually fit the traditional description of a venture-backed business. So it feels like, because of the way that we talk about it in the Valley, venture is everything. But actually, the vast majority of businesses probably shouldn't take VC.
Is it changing a lot? I mean, you're talking about traditional.
Yeah.
And so what are some of those major distinctions? I mean, that's a tough question to be honest about. Is this $1 billion company? Well, of course it is, I'm going to say.
100%.
Yeah. So what are some of those variables in terms of traditional outlooks in order for the founder to wisely look at this from multiple perspectives and get honest with themselves?
Yeah, it's you're totally right. I think basically in every single story of those biggest companies, you will run across hundreds of people who told those founders, this is not a venture-backed business. I mean, look at Airbnb as a great example. So many no's until you get to a yes. So it can feel like, well, every other founder did this. It's not rational for me to not be a venture-backed business. I just have to keep going, to keep pushing through. I think a couple things maybe would help you make that decision in a more logical fashion. So first off, once you take VC money, you're committing to those VC growth paths, which can change your personal life, can change the way that you want to do it. If you can't imagine doing anything else, maybe that's the first crux to say this is going to be a venture backable idea. Because if you can imagine doing this and also maybe another company or like playing around, you shouldn't take venture money. They're going to want you all in all the time.
Yeah.
The second thing is, how fast are you growing? There's this thing that's happened. You were asking about changes. There's this thing that's happened over the last couple years where a lot of people in VC started talking to their founders about profitability. When are these companies going to get profitable? How quickly is that going to happen? We should have a line of sight to profitability. I'm here to tell you that most of the time, actually almost all the time, the thing that matters is growth. You'll get a lot less questions about profitability from your VCs if you're growing 1,000% a month. That is what venture investing needs. They need growth. It has to be super high. Not to say that unit economics and profitability aren't important, but at the very earliest stages, seed, even Series A, getting to profitability is not the venture outcome that you want. It's getting to hyperscale. So it comes down to growth.
Right. And I think, for those, which has been hard for those founders in the past couple of years, because it's no longer growth at all costs.
Yeah, they're getting whipsawed back and forth.
Yeah, it's kind of contradictory. It's like grow very fast, but don't spend too much of my money. And I do think that is something, that they're wrestling with. But I also think in terms of deciding whether you're going to be VC or not, there are a lot of founders who just do not have the personal capital, or they don't want to invest the personal capital to do their own small business. Like I am a small business. I invested $3,000 in 2016 to start my virtual law firm, right? I've come from 4 generations of an agricultural business, right? That was bootstrapped because venture doesn't invest in that, obviously. And I don't think there are, in times when venture is free flowing, I don't think there are a lot of founders who have the level of capital they need to scale at the rate that they want to scale. And I think that's problematic. And that might be a hard reset because they're seeing all these other Silicon Valley companies, their cohort, their friends, their neighbors, their other guy who broke off from Apple to do blah, 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 scale at a faster rate with VC money. But in other parts of the country where VC money is not everyone has a check, you see slower growing businesses, right? And I think that the norm here, though, is a fast growth And this priority, or I don't think it's necessarily wrong or right, but there is this cachet of, oh, I'm venture funded. Yep. And founders like to tell other founders that. And that's why I'm able to scale this quickly.
So that's a humble self-assessment, though. You have to kind of break free of what's expected in Silicon Valley and make an honest assessment. How does a first-time founder have that humility? Is it just it's in them, or they have the right people around them?
I think they have to talk with the right people around them. I think I tell my friends all the time, because, a friend versus a lawyer conversation are different, but they're like, I want to start a startup. I'm like, really? You know how hard that is? They're like, you see people do it all the time. I do.
Yeah. Do you know what you're saying right now?
Do you know how they get divorced and stuff? Like, you know how their kids don't see them? I think it's a really hard thing to be very honest about in the Valley, because I think people are really pushing for that. And unfortunately, I think we've created this ecosystem where if you have received venture funding, then you're the man or the woman or the star, and if you didn't, then and you still have a very profitable small business, it's just not as good. Mm-hmm. And I don't think that's true, but I think that people feel that here.
They do.
And I don't know how we can culturally change that, because I think that goes again, that's a very expensive form of capital. That's a lifestyle change. That's a growth, commitment. And I think if you don't have the money to begin with, then obviously you gotta take something, right?
Sure.
But if you did have some money, anywhere from like $200,000 to $500,000 in savings because you worked as an Apple engineer for 15 years, then why would you? Why would you take venture, right?
I agree. I think that actually in the downturn, it's a chance for sort of more new investment in business models to maybe take a little bit of hold here. I don't think they're ever going to become like a dominant form of startup fundraising in the Bay, because this is about outsized ambition and trying to build the biggest companies in the world. But I think a lot of founders will end up building amazing, incredible businesses. Some of it actually just comes down to the words we use. Bootstrapped, lifestyle business, as opposed to venture-backed.
Right.
There's like something in those words that connotate someone who's going for it versus someone who's like, just kind of getting by. Whereas actually the lifestyle business might return way more capital to investors over its lifetime. And faster. So I think that maybe, I've heard revenue funded, just small business. It also, when we started this, it got into the idea, it's like all these businesses are tech startups, and it used to be that tech startup meant VC backed, and now tech is just a lot of small businesses.
As though it couldn't get worse, they've now introduced a jackhammer into the background.
It's part of the band, Brian.
It's part of my digestion.
It's like, it could be worse. It could be raining. Like, it could be worse. There could be a jackhammer, and now here it is.
Wherever Lindsey went just before this, whatever restaurant that is, we shout them out.
Okay, so
but soldier on.
Yeah. Soldier on. So again, we're talking about, what does it look like in order to scale? Strategies forward. What's kind of on the horizon right now that a lot of founders aren't aware of, but yet those who are in the heart of the ecosystem and the numbers need to kind of see? I mean, we're doing this for entertainment purposes. We can kind of just spitball and whiteboard. But what are some things that, whether you're starting out for the first time or you're a serial entrepreneur, what are the long-term pitfalls to look for? What are some opportunities down the line that we need to, as startup ecosystem, expand our vision on? It's kind of a general question.
I think there's a couple things that pop to mind. First and foremost is that AI, which has been the hype cycle for the last couple years, is getting sub-segmented. So it's no longer the case that you are going to walk in and wow everyone with the next gen AI concept. Maybe that'll happen, but it's less frequent. But AI is finding its way into other sectors, biotech, hardware, robotics, et cetera, where you wouldn't say this is flashy or OpenAI built it. It's not a chatbot, but it is deep ML in really interesting new ways. And that's kind of broadening. And that actually gets to the second point that I have from the data, which is VCs are becoming a little bit more friendly to non-software businesses, which I think makes a lot of sense. If you think about it, one of the things that venture capital should be good at is taking really risky bets on things that need a lot of capital. That's sort of why it exists in the first place.
So what are some examples that are non-software?
Robotics, number one, first and foremost. Green technology. There are multiple companies on Carta that are trying to build small nuclear reactors. That is not a business that you can do in a couple years, nor is it a capital light endeavor. So those kinds of things where it used to be the idea that VCs fund SaaS because SaaS is easy to predict. I think that is breaking down a little bit, and VCs, even traditional ones that maybe didn't look beyond SaaS, are getting more interested in other parts of the economy, which is pretty cool.
Nice.
I mean, I would love that to be the case. I feel like with our Seattle market and our San Francisco market, everything is SaaS or PaaS, and I data in there, but like CPG or consumer SaaS, which is less popular on our dockets than enterprise SaaS, are getting funded in other parts of the.
You see CPG companies getting funded because that's one of the things where
it's so hard.
I feel like that's a really tough one for venture.
I think it is. I think it really is tough for venture. I think consumer SaaS and CPG have always been really hard for me to pass decks here to our VCs in Seattle or San Francisco. I've heard of more VCs taking chances in Portland, which makes sense in light of Nike, in light of Adidas, in light of all of the other surrounding areas. I think entertainment tech is also really tough, but it does better in LA than it does anywhere else, right? I think there are certain parts where the country where there are bets outside of enterprise B2B to C or B2B SaaS or PaaS. I just wish I had more of a tap on that, because we do occasionally get like a retail tech or a entertainment tech or a what seems like a tech-enabled, consumer product or good, right? And we have no one to send them to here in the Bay Area.
Interesting.
Or we don't have anyone who we know is actively investing in that vertical. Even the ones that are stage agnostic and vertical agnostic, at least on their websites, which we all know is different than in reality, but that's not what they're looking for right now. I think what I have been told everyone is really looking for is AI enterprise or AI enterprise adjacent.
Yeah.
Right now, it's all I'm hearing.
It's definitely super hot, but I think you touched on a point that I would maybe want to double down on, which is venture across the US is not a monolithic thing. Different parts of the states have very different competencies that they sort of play in. So fintech, the Bay and New York.
Yeah.
Gen AI is focused in the Bay. Energy, Denver. Florida is very strong in gaming, and Austin has hardware and some other Texas cities. It depends on what industry you're in, but you may find like more hospitable waters for your sector based on where you're trying to fund it.
So positioning is key. I mean, especially if you're, I mean, you could live in Silicon Valley, you might want to relocate there, or if you're coming in.
I think a lot of our foreign companies from Europe will come to Silicon Valley. This is one of the biggest, California itself is one of the biggest markets in the world, right? So that's a no-brainer. But I do think some of our companies who are fintech will go to New York. Why? Because that's where the money is. That's where they're making a lot of investments. Or if they're pharmaceutical tech, maybe go to Boston or something like that, or San Diego if they're early stage enough, right? Because there's different funders that fund different things. And when I go down to San Diego to speak on venture with venture guys there, all they're doing is like hard sciences, right? And so I think we try to tell people to go where the money is, if there is a possibility. But then of course you have that entrepreneur with like 4 kids who are all in private school at this place, and they cannot just pick up and move to New York from Seattle or from Oregon, right? Yeah. And that's, it's a choice.
It is a choice.
Do they need to be positioned there though? I mean, I asked the question one way before, but to go to the other side of it, do they really need to be there?
I think VCs have, at least, and Peter, I'd love to hear what you say, but like I'm hearing a lot of like during the pandemic saying we're location agnostic, we're vertical agnostic, we're stage agnostic from a lot of big VCs. At the earlier stage, I've heard we're stage specific, vertical specific, but we're location agnostic. And I just don't think that's necessarily true. I feel like from the foreign founders from Europe or Canada with no connections, they need to go where their partnerships are and where the VCs are funding them. I even think I still do feel that way for American founders as well at the early stage, and provided that you're not, of course, a repeat founder, right? If you are a first-time founder at the early stage and you are in therapeutics, right? Then I would say San Diego
or Boston.
Yeah, or Boston. I wouldn't be in the Bay Area. Unless you were softer tech, like a health tech AI or something like that.
I think there's no black and white answer to this, but does it help to be near to your customers and your funding? Yes, it does. Absolutely, it does. It will make a difference. You will be able to be
You're
in these
faster.
people's minds more quickly and more solidly than if you are emailing them from Germany.
So that matters. Okay, we got about a minute left of the show and the jackhammer. We got about 2 minutes left. So, Lindsey, I'm going to start with you. What are some high-level insights and takeaways for our audience at this point in order to kind of, we talked a lot about strategy. We talked a little bit about go-to-market. We talked about partnerships. We also talked a little bit about founders. What are 3 takeaways from you from all we talked about that can be top of mind tomorrow?
So I guess one, and we didn't talk about this quite yet, but choose your co-founders right. 1/3 of our practice, unfortunately, is helping co-founders business divorce, which is the messiest thing at the early stage, especially after round funding. And in tough economic times, you really see people's true colors. And I think that we've had a number of hairy either spin-outs, reorgs, buyouts, et cetera, in the past couple of years because of tough times, right? And people just not really wanting to make it through. So I guess that's number one, like choose the appropriate people, which is, I guess this could be said about marriage too, in so many ways, but it's equally comparable.
It's the right analogy.
It's the right analogy.
Sure.
Yeah.
And then, obviously we talked about a lot of factors like ARR, we talked about founder market fit, product market fit. I think sometimes people think that these are like exclusive to each other. I think they're on a balance. I think that has to be emphasized that VCs are not looking just at your ARR, just at your product market fit, or just at your scalability, or just at your founder market fit. They're looking at all of them across the way, right? So it's not just a hard and fast rule of like you check all these boxes and you will get funding. And I think that's also a common mistake that founders think of. It's like, well, I have this, and this, and Lindsey said these are the things, so why am I not getting funded, right? Why is that guy getting funded and not me? And I think there's more intangibles there than maybe even Peter and I even discussed. And the third, I think that we are still seeing is that more money to less people in bigger chunks. I think that's the takeaway that anecdotally I'm seeing at least.
Wait, say it again.
More money in bigger chunks to less people. Right. So the cream of the crop is really rising, right? So instead of giving a VC giving a lot of 500 to 1 million on safe notes, they're really concentrating their investment in that one seed company, and they're giving bigger amounts of money, right? They're going to give like 3 million to that guy, and they're going to cut all the other guys that are kind of like, okay, but we don't know, right? I think they're feeling the pressure of their LPs, institutional and individual, especially for early stage VCs who actually rely on $50,000 checks from LPs individually. Like humans are humans, like, they can be an 80-20 problem. I think in this stage, they're being pickier about how much they're giving and to whom. And so you're going to see the have and have nots. And the ones that are getting it, at least that I see, are repeat founders who already have ARR at the right levels, who already have the partnerships going, who already have a scalable business model.
Totally.
Yeah, you got about 30 seconds.
I think the number one thing that you should take away from this conversation, if you're a founder, maybe 2 things really quickly. First and foremost, double down on the co-founder thing. You can found businesses alone. You can be solo founders. That's possible. Second thing, VC will get better. There will be more fundraising in 2024 than there was in 2023, but it's not popping back to where it was in 2021. So you can just ignore that part of the market.
So, Lindsey, how can people connect with you?
LinkedIn is fine. Also email lindsey@ssm.legal.
All right. Peter?
Find me on LinkedIn.
All right. Thank you both for being here.
Thank you for having
You're
us.
amazing
Yeah, appreciate
guests.
it.
Brian?
Yes.
Let's get away from these jackhammers.
And once again,
And I'm not talking about Lindsey, and I'm not talking about Peter. All right, and that's a wrap. Thank you for listening to Silicon Valley Impact. You can join us here every Tuesday from 3 p.m. to 4 p.m. Make sure to follow us on Silicon Valley Impact on LinkedIn and listen to us on Spotify. Have a good week, everybody. Talk to you soon.